We talked about the board of directors of a corporation decides whether or not a dividend will be paid. It's the same thing for a mutual fund. Whether or not a dividend will be paid and how much it will be is determined by the mutual fund's board of directors. I said dividends can be paid at most quarterly. It's also true, as we learned in section 1, that the ex-dividend date for a mutual fund is set by the board of directors. It's usually the day after the record date. We talked about at most the mutual fund may make a long-term capital gain distribution one time a year. As a shareholder, you have no ability to influence the timing of a dividend or capital gain distribution. Any short-term gains that the mutual fund portfolio had comes through to the investor in the form of dividends. So the dividend income is short-term capital gains. It includes interest on the bonds in the portfolio as well as dividends on the stock. So I want to show you a mathematical example of what would happen to your cost basis if you automatically reinvest income distributions. So let's say in January of 2013, you bought shares of a mutual fund where the bid price was, let's say, 15 and the ask price was 16, okay? So the client always buys at the ask. So this is what they pay. We also call this the public offering price. So we're buying mutual fund shares with after-tax dollars. After-tax dollars. So this represents their cost basis, or simply their basis. Now let's say during the year, the 1099 says that the income distributions in the form of dividends were $1, and the capital gain distributions were $3, kind of to go on my example before. So that's a total of $4 that is taxable to the investor, whether or not the investor took this in the form of cash or left it in the fund. So the capital gain is taxable at long-term capital gains rates, and the dividend is taxable as well. At what rate? That we discuss within the tax section of the course, because that gets kind of complicated, but it is taxable. So spend it in cash, taxable. But if you leave it in the fund, still taxable. So it's important to remember that if they left it in the fund, used it to automatically buy more shares, that their cost basis per share is increased by the amount of automatically reinvested dividends and capital gains. So if down here in February of 2014, they redeemed their open-end mutual fund shares when the bid was 21 and the ask was 22.02. How much do they owe taxes on? So we buy at the ask. The ask is the public offering price. We redeem at the bid. A synonym for bid is net asset value per share, or the redemption price. So it's really easy for students to go, oh, $5. No, you have to remember that you already, when you reinvest, pay taxes on the $4. So at this point, our cost basis is 20. So we would owe taxes. This is a long-term capital gain, so they'll give you a holding period on $1, on $1 per share. So just keep track. It's important that the investor remembers that automatically reinvested dividends and capital gains have the effect of increasing their cost basis. I don't know that the IRS gets mad when people pay taxes twice, right? We don't ever want our clients to do that. We talked about capital gain distributions made by a mutual fund are always long-term. Any short-term gains they have come through to the investor in the form of a dividend. If the client had sold their shares in December of 2013, if the holding period for the share is a year or less, That's a short-term capital gain. Short-term capital gains are taxable at ordinary income rates. Short-term capital gains are taxable at ordinary income rates. That's true also for interest on bonds. Bond interest, if your client just owned one bond, for example, interest paid on bonds is taxable as ordinary income as well. Just so you know, there's so many things to keep track of. It's true that the fund has to disclose the source and character of any distribution that they make. So whether or not it was dividend or capital gain, how do you know what it was? You read your 1099, your Form 1099. If you bought mutual fund shares and sold them for more than your cost basis, you have a realized gain. A year or less holding period, taxable as ordinary income. A year and a day or longer, taxable at long-term capital gains rates. We already talked about automatically reinvested dividends and capital gains. Increase your client's cost basis. If the client bought the shares for 10 and now they're worth 15, but they haven't sold them yet, that's unrealized appreciation. That is not taxable yet, subject to market risk, as we previously mentioned in Section 1. An investor's total return for a mutual fund investment includes income distributions, gain distributions, and share appreciation. Current yield is different. Current yield, we talked about current yield on a bond and current yield on a stock. Current yield on a mutual fund is distributions, dividend distributions divided by current market price. You cannot say current yield includes appreciation. No. Total return. Have you ever seen a mutual fund advertisement and thought, that sounds too good to be true? It's because they're advertising in total return. Current yield only looks at the dividend distributions over the past year divided by current market price, where total return looks at dividends, capital gains, and appreciation divided by current market price. So they have to be very specific when they advertise. They can't compare current yield of one fund to total return of another. That would be misleading. It gives an example. If the ABC Mutual Fund has a current offering price of 10 and over the past 12 months has distributed dividends totaling $1 and gains totaling $1, the current yield for the fund is the dividend distribution of $1 divided by 10, so 10%. Total return would be the 1 plus the 1, and what was the appreciation? What was the share price last year? Maybe the share price last year was 2. Well, that would be huge. So total return can be misleading. You can advertise using it, but you have to follow very specific rules. We talked about in order for your client to determine what their tax liability is, they need to know their basis. So their cost basis, after-tax dollars that are in the fund. We buy with after-tax dollars. If we automatically redeem, we automatically reinvest, those are also after-tax dollars. You don't have to pay tax on your already taxed dollars twice. It's possible that when you sold, or let me say it properly, if it's an open-end fund, you never sell your share, you redeem it. It's possible that you paid more than you were able to get when you redeemed it. That would be a capital loss. So we have this ability to net together our gains and losses, which I will show you in just a moment. It is true that mutual funds are required for any mutual fund share purchased as of January 1st of 2012 or later to disclose the investor's cost basis to the IRS. It's called cost basis reporting. If the shares were purchased prior to January 1st of 2012, the responsibility for tracking the cost basis falls upon the investor. Today, as part of the account opening process, mutual funds will ask the investor which method they would like to use for cost basis reporting. Mutual funds generally will make available for the client things like average cost basis, LIFO, which stands for last in, first out, FIFO, which stands for first in, first out, and some other methods of specific share identification. So the client has to choose what method of cost basis reporting they would like to use. Mutual funds also will have a default method for determining the cost basis of mutual fund shares in case the investor never specifically chooses a method. Exactly what the fund's default is varies by fund. There's no rule that says it must always be something. So there's no really standard thing that the default method will be. So it would be really good for you to know what your fund's default method is if the client doesn't choose. Many funds do use a default method of average cost basis, but not all funds will do that. The investor can always change the method for reporting cost basis by giving notification to the mutual fund company. If your investor chooses first in, first out, what that means is that you want to tell the IRS the shares you bought the longest ago are those that you just sold. Generally speaking, you will have the largest reportable gain if you use FIFO, because generally speaking, the shares you purchased the longest ago, you paid the least amount of money for. So that's what happens if you choose FIFO. If you use specific share identification, then the investor has the most flexibility to reduce their investment-related taxes. Generally, the easiest way to keep track of gains for the shareholder is to elect the average cost basis. The mutual fund company simply calculates the investor's average cost basis by dividing the total cost, so how much money was invested, of all shares purchased by the total number of shares owned. So when the client chooses a cost basis reporting of average cost, how does the fund keep track of it? So total cost, so amount invested, divided by the total number of shares purchased. This gives you the average cost. So that's really the easiest, which is why many funds will default to doing average cost. When more shares are purchased, the average cost has to be recalculated. And then the average cost is subtracted from net asset value at redemption in order to determine the amount of the gain. The cost basis of an investor's mutual fund shares includes what they paid for the shares. So if it's an open-end fund share, they buy at the ask. If, however, it's an exchange-traded fund or a closed-end fund, they would buy at the ask plus, generally speaking, pay a commission. So cost basis does include sales charges. Investors, as well as the fund itself, has to keep track of the basis in order to calculate capital gains or losses upon redemption. Now, two little things, there's two sentences that are two questions, so I have to kind of elaborate here real quick. If you are gifted securities, okay, so if you are gifted securities, so let's say Uncle Bob, he loves you. Uncle Bob bought mutual fund shares in 2000. And when he bought the mutual fund shares, they had an ask of 10 and a bid of 9. And today, Uncle Bob made you a gift. And today the bid is, let's say, 30, and the ask is 32. Okay. When you are gifted securities, including mutual fund shares, you will assume the original cost basis and holding period. So if you were gifted the shares today and you decide to redeem them, redeemed 6 months later, when the bid is, let's say, 31 and the ask is 33, what's your cost basis? Well, let's see, what did Uncle Bob pay? Bid and ask, what do you buy at? You buy at the ask. And when you redeem, what do you get? You get the bid. So we've got a $21 per share long-term capital gain. You only had them for 6 months, but when you're gifted securities, you assume not only the cost basis, but you also assume the holding period. So you bought them in 2000. So that's one question. What else might they ask? Now, Uncle Bob, he died. Oh man, Uncle Bob. So you inherited these securities that Uncle Bob bought in 2000. So today, he died. When you inherit securities, they are inherited at their fair market value as of date of death. So they are inherited at their fair market value as of date of death. And no matter how long you hold them, whether or not you have them for 6 months or 6 years, whenever you sell inherited securities, this is one of the nicest things the IRS does. They always treat the gain as a long-term capital gain whenever you inherit securities. So they're inherited at their fair market value. So you would have an ask, basically, your cost basis would be 32. They're inherited at their fair market value. And no matter how long you held them for, you would only have to pay taxes at long-term capital gains rates. So as of the day of death, inherited as of the date of death. So 2 different questions there. I had a student, oh man, this was years ago, and he told me that in the early 80s, he was losing his shirt in the stock market. I mean, losing everything. And he thought, well, I'll just lose as much as I made when I went to work this year because I'm going to write it all off. No. He said his wife and his accountant almost killed him. So there's a rule as far as what do we do with our capital gains and our capital losses every year. So capital gains and losses, securities investments, we take our capital gains, and let's say our capital gains this year were $10,000, and we look at our capital losses. Let's say our losses, let's say this was this student's story. He did not tell me how much, nor did I ask. It didn't seem appropriate to ask. We take our gains and our losses and we net them together. So we won't owe any taxes on our long-term capital gains because we have losses in excess of our gains. So he was left with this large loss that he thought he could write all off against his ordinary income. No way. The IRS does, however, allow you in any given year to write off of your capital losses up to $3,000 against your ordinary income. So I like to call this legalized gambling. Everybody should lose $3,000 every year in the stock market, because if you don't, you didn't play hard enough, because you can always write off $3,000 against your ordinary income. So the $27,000 that's left, that becomes a carry forward into the subsequent tax years. If he never ever again had a capital gain every year from now until it was all used up, he would write off $3,000 against ordinary income until it was all gone. However, if he had had in the next year a capital gain of, let's say, $27,000, how much would he owe taxes on? So he'd take his loss, net it against his gain, and he would owe no taxes. So you do have this carry forward of your capital losses. Wash sales. The IRS wants to make really certain that when people sell a security and have a loss, that they're not doing it just to create the loss to net it against the gains. So they have this rule that says whenever you sell a security at a loss, you cannot have purchased the same security within 30 days prior here's the day of the loss, or 30 days after the day you sold it for a loss. For a total of how many days? 61 days. So if you sold it for a loss, but then you bought it back here, the IRS is going to disallow the loss for tax purposes. If you bought 100 shares here and sold 100 shares for a loss here, they're going to disallow the loss. So substantially identical securities. So the same stock, same mutual fund share, or it could be a convertible bond into the same stock that you sold at a loss. That would also be considered a violation of the wash sale rules. The purchase of options in the same stock that you sold that you had a loss on would also violate the rule. The AMT tax. AMT stands for the Alternative Minimum Tax. It was created in the early 70s to make sure that everybody was paying their fair share in taxes. So basically what it does for certain types of clients is it takes away some of their write-offs, the alternative minimum tax, and makes sure that they're paying their fair share. This section has questions on taxes. So we did a little bit about the tax effects of mutual funds. Now we have to do a little bit about taxes on annuities. But we haven't done the full product discussion yet of annuities, so let me give you a preview. So a variable annuity is an insurance product that allows a person to invest premiums. The premiums go into the insurance company's separate account, which really acts similarly to a mutual fund and invest in the stock market. There's no guaranteed interest rate. The variable annuity itself has a feature that is quite different from the tax effects of a mutual fund. So when you buy a mutual fund, you pay in after-tax dollars to buy it. That's your cost basis. Dividends distributed, capital gains distributed are currently taxable. But when you have a variable annuity, you put money in. You're in what's called, before you annuitize. To annuitize is to take out a dollar amount monthly for life. So we're in the beginning, what's called the pay-in period. During the pay-in period, any earnings in the separate account are tax deferred. Earnings in the separate account are not currently taxable. They're tax deferred. The money that goes into an annuity product is after tax dollars. We are not talking about qualified plans yet. After tax dollars. So not currently taxable, tax deferred during pay-in. We also call the pay-in period of the variable annuity the accumulation period. During the accumulation period, you have in a variable annuity what are called accumulation units. During payout, you have annuity units. During pay-in, you have accumulation units. So no taxes owed currently. If, however, the client is in a tax-deferred annuity, which this one is, this variable annuity, let's give an example. Let's say they funded it with a single premium. You can put in a single premium, you can put in a level premium, you can put in a flexible premium. The insurance company doesn't care. There's always a beneficiary during pay-in. If you die during pay-in, your beneficiary is going to get the value of your account. It's not protection. It's not like life insurance where you must pass a physical. So here when we're in pay-in, it is possible, if we have not yet annuitized, it is possible during pay-in to take a partial or full withdrawal. It is possible during pay-in to take a partial or full withdrawal. So, for example, let's say that the account balance is $70,000 and you started funding this variable annuity with your single premium when you were 30 and now you're 55, just to give us a story. and you decide to take a partial withdrawal. What happens on a partial withdrawal, we're in pay-in, because once you annuitize, you can't take a partial withdrawal. What happens, the IRS says, to a partial withdrawal during pay-in is LIFO, last in, first out. So this $10,000 that you took out is 100% taxable. How is it taxable? At ordinary income rates. So in exchange for the tax-deferred nature of the pay-in, when you take out your earnings, they're taxable at ordinary income rates. It's also important to realize this is a retirement product. If you're under age 59 and a half, which in this case this person is, there's a 10% early withdrawal penalty. So not only is this $10,000 taxable at ordinary income rates, but there's also a 10% early withdrawal penalty. Something else they could ask, let's say you decide to take a full withdrawal of the $70,000 at age 55. How much do you owe taxes on? The earnings, which are $20,000. How much, at what rate is it taxable at? Ordinary income. What's the penalty on? The 70 or the 20? The penalty's on the earnings only. If you take out the earnings under age 59 and a half, the penalty is on the earnings only. We do have exceptions to the withdrawal penalty. If the withdrawal is due to death or disability, then we will waive the 10% early withdrawal penalty on the earnings. We're never going to waive the ordinary income rates that are owed on the earnings. So LIFO on a partial withdrawal during pay-in. Now, a lot of times the test acts like the best feature of the annuity is that it has tax-deferred earnings, and that's absolutely a wonderful feature of an annuity product. Something else, however, that you could do, and not everybody does, but you can choose to annuitize. So kind of just to review our story here, you put in a single premium, $50,000 at age 30, and we were in pay-in period. And let's say we annuitize at age 60. So to annuitize is to start the dollar amount monthly for life. So they look me up on the annuity table. They think I'm going to live to be 80. So they're going to take, let's say my account balance is $200,000, and they're going to pay me my money by the time I should die. This is called the payout period, where I have annuity units. If I live past 80, which, heck, I'm probably going to be 105, I still get paid a dollar amount monthly for life, but I'm getting someone else's money. Cool, sign me up. I'm getting someone else's money. So the test wants you to be aware of what are they going to do as far as taxes go during pay out on this annuity product. So, and it's very simplistic. We don't worry about earnings and payout. Granted, there are earnings and payout, but it's just basic math. So if this is my account balance when I annuitize, $200,000, they're going to pay it to me over my life expectancy, which is 20 years, which I picked because, math is easy this way. That's $10,000 a year. They take my cost basis and they spread it out over my life expectancy. So $50,000 divided by 20 years. My cost basis is my after-tax dollars. They cannot tax me on that. I've already paid taxes on that. So $2,500 a year is tax-free. I already paid taxes on that. $7,500 is taxable. How is it taxed? Ordinary income rates. If I live past age 80, I'm getting someone else's money. It would be 100% taxable as ordinary income. So remember, when you annuitize the contract, they spread out your cost basis over your life expectancy so that during the time in which you're getting your money back, some of it is taxable and some of it is tax-free. Should you outlive your money, all of it is taxable to you because none of it is your money coming back to you.